it's great to see you again. Thanks for making the time to have this conversation about subscription commerce and a problem that plagues many subscription commerce companies. So thanks again for making the time.
Yeah, I'm really excited to dig into this. We co-sponsored this beautiful report, some really exciting takeaways and insights in it, and I've been looking forward to this conversation to kind of dig into it a little bit.
Me too. I want to give you a little bit of a setup, though. So here's the setup. Adam Smith, we all know who Adam Smith is, famous economist, said that free markets in pursuit of profits are led as if by an invisible hand to do what's best for the world. You say that subscription commerce companies have their own invisible hand to guide what's best for the consumer and therefore what's best for subscription commerce companies. So what is that invisible hand?
Yeah, that's a great setup. I love it. Well, we have a lot of data now that shows that when we're dealing with this problem of involuntary churn and failed payments, the best strategy for remedying this problem is invisible recovery. In other words, the more we can do to solve the issue without having to annoy our customer, without having to make them and get them involved as a stakeholder and bringing in new payment information, or even just making them aware of the fact that there was a problem, all those things are actually contributing to more churn and a negative brand experience for the consumer with that merchant. So invisible recovery is the best recovery. And whatever we can do to invest in, it's a great quote. I love that out of the quote. That's a great tee up. Yeah, the invisible hand that's out there helping the subscription companies reduce this major pain point really is invisible recovery. And it's big because of all the causes of churn that are out there, customers that are fatiguing, switching over to a competitor, things like that, the number one single largest cause of churn today, in the study that we did, is the involuntary churn. It's the failed payments. 48%, I think, was the average across all the merchants. Yep. We have some clients on our platform that are as high as 60%. So really, really big problem. And what we do to remedy it is extremely important. Invisible recovery first is the right strategy.
So Daryl, we've talked about this in many other conversations, but I want to come back to the fact that subscription commerce is a business model based on a particular type of payment. Payment is a very important part of the subscription commerce value proposition. Obviously, it has to be a good product, has to be, flexible terms, and all of the things that go into making a great subscription experience. But if payment is fundamentally what the business model of subscription is about, why are we suffering? Why are 90% of subscription commerce companies suffering from this involuntary churn as caused by payment declines? It doesn't sync.
Yeah, it's interesting because you'd think that everybody involved in the payments ecosystem is incented to make sure that these transactions go through. But sadly, what's happening right now is that we have, significantly increased activity from cyber thieves and hackers. There's a tremendous amount of complexity that's come into the payments ecosystem with all these new devices that are, and the Internet of Things and smart wallets and things like that, which promise in some cases to actually make things better. But actually the extra complexity in and of itself becomes a problem and a source of friction. And we also have to understand that the existing payment rails that power our economy really haven't had a meaningful update to them since 1987. These are old legacy systems. It's very difficult to make changes and upgrades to them because of the sheer volume of transactions they're processing and the really tight windows and SLAs within which they have to make decisions. But now you get you have all these complexities and you have these cyber thieves and criminals with databases of stolen credit card. And we're seeing a significant increase in fraud losses that the issuing banks are having to swallow. And even if they don't have to eat all of the fraud loss, either because they're able to push it back onto merchants or they also insure themselves with insurance carriers, they still have an incentive at their core, a fiduciary responsibility to reduce these fraud losses, right? And and there is a cost on their own P&L and on their own balance sheet because the deductibles on their insurance policies are going up recently. Premiums are also going up. It's about a $30 billion a year fraud losses that the issuing banks are facing with. And the only tactic they really have at their disposal is to try to decline transactions that look suspicious. And because there's not enough data currently available, this is why we see this massive amount of friction. They're making decisions with imperfect, incomplete information, and they get it wrong a lot of the time. It's because they're missing the data, and they're also running on these old legacy systems that just aren't able to make decisions in the proper way. And so what we see is like that $30 billion in fraud losses for the issuers is turning into $400 billion in false declines that the merchants are having to struggle with. The average false decline ratio in America today is actually 7-to-1. That means for every one actual fraudulent transaction, the banks are willing to decline 7 kind of sketchy looking transactions, but that are actually legitimate. It's a huge problem in our economy right now. So, and it's sad because so many merchants don't even really fully understand what's happening. We have these conversations all the time. They're like, well, there must be something about the economy. You know, maybe it's because of the pandemic. People's wallets are tighter. I mean, I'm just seeing all these increases in do not honor and NSF. Well, almost 95% of all of the declines that happen under the do not honor reason code are because of a fraud system at the issuing bank that's gotten involved and said, no, we don't trust this transaction. We want to block it for whatever reason. So this is a message that you and I have been working really hard on getting out is, hey, there's something you can do about this. You don't just have to take these losses. You don't have to just take these declines or suffer through all this friction that's happening inside of your business with your customers. And the issuers are actually interested in solving this problem. The networks are interested in solving it, but the solution isn't really evident. And there's no one single point of control because each of the 8,000 issuers in America makes decisions independently of each other as to which transactions will be approved or declined. And they get it wrong a lot of the time, unfortunately.
So I want to put the size of this problem in context with respect to subscription commerce itself. So, data that we have, 8 in 10 consumers have subscriptions. I mean, we all have subscriptions. A lot of us have a lot of subscriptions, but it's available. Almost every consumer has one. 1 in 3 consumers add a new subscription to their portfolio every month. So this is not only a part of what consumers have, it's a growing part of the subscription commerce economy.
And don't we know this intuitively too, right? It just seems like everything is turning into a subscription these days. We used to just buy a license to a piece of software. No. Now it's an annual recurring subscription, right?
For sure. So now let's talk about the problem that we've just been describing, and where invisible recovery can make such a difference. So payment declines prompted 27% of subscribers. This is the work that we did together to terminate their accounts. Just flat out say, I'm done. That was a bad experience. I'm leaving. Involuntary churn. Then 38%. So it's a big number. 38% of consumers that were on the fence, not exactly satisfied, took the opportunity with the payment decline to cancel their subscription. I mean, those 2 data points alone are significant. And those are the kinds of things that I think when you and I have talked about this, those are the things that can be saved.
Yeah, really powerful insight, isn't it? Right? We all, no matter how good of a job we do in investing into our products and our services, we're always going to have a certain cohort of customers that are kind of sitting on the fence.
Right.
They're somewhat engaged with the brand and with the product, but somewhat not. But they're happy to stick around and continue to pay for whatever reason. And yet when we have this failed payment, right, especially the false declines, if we then go engage with the customer and say to them, hey, you have a problem here, I need you to fix it, especially if it's for an NSF, it's very embarrassing, right? Like you're almost going to your customers, and the way that they can perceive this is saying, what do you mean I'm not credit worthy, right? You're telling me I'm not credit worthy. And now you've taken someone who's kind of on the fence and turned it into clearly a very negative, embarrassing, frustrating sort of situation. And so this is where the real power of the insight of invisible recovery comes in. We should not be putting this on our customers to go and fix this problem. We, as the merchant, should be doing everything that we can to fix the problem in the payment rails first. Even if you have the best, highest quality white glove customer service with, one of these new cutting edge AI driven digital engagement tools, and sending, clever text messages and emails with the right content and the right cadence and stuff like that. Even those best in class tools aren't going to perform as well for your business overall as the invisible recovery. And it just kind of makes sense when you really stop and think about it. Why should you be engaging with your customers to fix this problem if you can fix it yourself and not suspend their service? That was another interesting insight from the study, that the merchants that are suspending the service as soon as there's a failed payment are also really irritating their customers and massively increasing their churn compared to the merchants that didn't immediately suspend the service and did some work behind the scenes to see what can we do to actually remedy this.
Yeah. In fact, 39% of those who had their service interrupted said bye-bye. And every single baby boomer did in our study. I mean, they have no tolerance.
Who knew that was going to be a trend that came out, right? Yeah. The baby boomers were like, oh, you're going to suspend my service just because a transaction failed through? See you later.
See you later. I mean, that was kind of astonishing, in part because I think they have a lot of other experiences across a lot of other providers and can take their business elsewhere. And I think that's exactly what happened. So, I think this just reinforces the point that there are lots of things that, consumers legitimately have questions about. I don't need the product anymore. The service isn't flexible enough for me. Things that are product and service related. These are the kinds of things that can be addressed without prompting a consumer to then say, do I really need this? Do I really want this? Is this really the kind of relationship I want to have with this subscription commerce company?
Yeah, and sometimes, these are very, nuanced and complicated sort of decisions. I mean, we're getting almost into the human psyche and behavioral psychology and things like that. People are able to rationalize their decisions any which way, right? But the reality sometimes is very, very different. They can tell you that they're making a decision for a certain reason, but the data actually indicates something to the contrary. And while a customer can say to you in an exit interview, in a disposition report or something like that, that they exited from the brand for a different reason, what the data is clearly showing us is that the merchants who are suspending service immediately on a failed payment and then relying heavily on engaging with the customer, letting them know about this failed payment and asking the customer to do anything about it, all three of those things are significant drivers of churn. So we don't want to be notifying our customers except as a last resort, right? And if we do notify them, is there a way that we can make it as easy as possible for them to remedy this, right? But then first and foremost, the invisible recovery strategy, really, really important.
So we have chatted about the power of invisible recovery. We obviously have the data that supports, the impact on, the top and the bottom line, because when you lose a subscriber, you need to get another subscriber. And so there's effort that's put into that, depending upon where they are in the life cycle. You probably haven't recovered the investment you've made to get them as a customer. So, you've lost twice. What is the key takeaway, Daryl, that subscription commerce companies can do to really take this, operationalize it, and make this part of a best practice so that they can become the top performers that have all the other things that are great about their product, but also have this as a way of addressing this customer service problem?
Yeah, so there's this new category that's really starting to emerge, and we've been doing a lot of work together and trying to create a little bit more awareness around it. Payment authorization management. All these tools and strategies fall within payment authorization management. There are a lot of tools available. The sequencing of the tools is extremely important, right? Like making sure that we've got our invisible recovery first, followed by our digital engagement second, and our customer success third. And then also, what tools are we going to use? And there's lots of invisible recovery solutions. Which ones are better and why? Same thing with the digital engagement piece and the customer service piece, right? So there's different options available. Which one's going to be the best fit? But I'd say first and foremost, it starts with creating some awareness, right? Peter Drucker 101, what gets measured gets managed. Right. So I really encourage everyone who's listening to this, who's running a subscription business, go in and take a look. measure how much of your business is being impacted by false declines. What is your failure rate on fresh attempts every month? And it's surprising sometimes when we go in and look at this to see how meaningful it is. Again, the data has clearly shown that it is the single largest cause of churn is these failed payments. The average is 48% of all of our churn coming from failed payments. So we've got to go in and take a look at it. Once we take a look at it, then we can say, well, what are we doing about this right now today? How effective is it? What are the other strategies that might be available to me inside of payment authorization management? Choose the right strategy that fits for you in the right sequence. And then once we roll it out, we want to measure, we want to iterate and kind of improve from there. It's an ongoing process, but that's really the call to action on this. Go in, take a look at it, quantify it, look carefully at the strategies you're using now, make sure they are ideal. And there's more than likely an opportunity for upgrade in the way that we're approaching this problem.
So if 50% roughly of churn can be addressed just by addressing this in a way that is not intrusive to the subscriber. Let's think about what that means to the subscription commerce business in terms of the overall health of the business, their ability to invest in growing the business, their ability to not invest in acquiring new, but retaining existing, adding to the portfolio, selling additional things to existing customers, putting more marketing to acquire customers that can then stay as part of their subscription commerce portfolio. I mean, let's talk about the positive side of addressing this problem and what can be done to improve the business as a result.
Yeah, the beautiful future that awaits for you when you get this right, when you really kind of dial this in. So we know intuitively that if we're able to attract a fixed number of customers per month, right? The world is not infinite in the number of people that we can attract for our particular subscription. Eventually it'll plateau. Eventually at a high enough rate, we'll be losing just as many people as we're acquiring. Right. The lower we can reduce our churn down by, the higher that number is, but it's exponential, right? It kind of falls into the realm of this idea of compound interest. One of the wonders of the world, right, is that if we get this right and we lower our churn number down even just a little bit, we get an exponential return in the lifetime value, because we're not just a lifetime value of our customer base, because we're not just fixing that one transaction when it's a subscription, we're actually fixing a customer. And that means that they're going to be eligible to be billed 30 days, 60 days, 90 days, 120 days from now. So we're getting compound returns on every effort that we make in bringing down this churn, right? So that's really important. That significant increase in lifetime value also results in an outsized return in net profit. Why? Because one of the single largest costs that we have in running our business is the marketing. In marketing, we usually calculate it as a percentage of gross margin. Well, if our marketing costs are fixed and we just increased our gross margin significantly, now our marketing costs as a percentage of gross margin are more ideal than they were before. And now maybe we can go after different cohorts of customers that previously were not profitable, but we can afford to spend a little bit more on marketing. We're now competing more against our competitors for that customer space. And our competitors are looking and saying, how in the world are these people spending this much on acquiring customers? How can they possibly afford to do it? Well, the way they're affording to do it is because they are more optimized in their returns. They're more optimized in the lifetime value that they're generating off of it. So it's been phenomenal to see the compounding effects that come in on this as they go along. And better marketing budget, higher lifetime values, much better, gross margin, all these key performance indicators that we really see the world-class, most sophisticated and most successful subscription companies all have in common. And this one thing punches way above its weight, so to speak.
Investing in the customer experience in this sense is an opportunity to really invest and grow the business, because you can put more of those funds into product innovation, product extensions, and things that continue to keep subscribers engaged. You mentioned top performers. Are there certain sectors of subscription commerce, the subscription commerce economy, where this is done well, and conversely where there's still a big problem that needs to be addressed? I mean, obviously there's a lot of big problems that need to be addressed, but are there top and bottom performers?
What we find interesting in the data that we've collected is that there are top and bottom performers in just about every market
Yep.
segment out there in the economy. It's
Yep.
crazy. It's hard to say, like, for example, SaaS subscription companies, right? Software as a service, technology companies, generally speaking, are much more dialed in and focused on their
Yep.
KPIs and focused on optimization and efficiency, but they're not massive. It's not like orders of magnitude more sophisticated. What we see is in each market segment, there's usually a few leaders that have come to the top and have separated themselves from the pack. And they're always the ones that are extremely dialed in on operational efficiency. They're really optimized. They're on top of all their KPIs. They're very informed. They know exactly what their numbers are around, for example, churn and false declines. They already have a strategy that they're rolling out and using internally with limited success. And they're on the hunt for ways that they can constantly be improving that. And this exists in every category. We're looking at direct sales. We're looking at not-for-profits. It's interesting how you and I were talking about everything seems to be turning into a subscription these days. Well, look at all the charities that are out
Yep.
there that have launched monthly gifting and
Yep.
donation.
Yep.
And it breaks my heart to see these amazing charities that are solving interesting problems that are struggling with 10, 12, 15% failed payments on first attempts when they go to charge the cards. And the customer's saying, I want to give you money to go help this really great cause. And they've got failed payments in the way, right? So SaaS as well. We even see like, legal services and things like that, installment plans. It doesn't really matter what market segment they're in. It seems to be pervasive across the board in all market segments, but in every market segment, there are leaders that again have separated themselves
Yep.
from the pack because they've got good strategies around this.
Daryl, how does this actually integrate into a subscription commerce platform? If somebody wants this invisible recovery,
Mhm.
what has to happen? What do they do?
Yeah, there's a lot of different solutions out there. Some are built into the platforms, some are built into processors, and then some are third-party agnostic solutions, right? Where they're processor agnostic, platform agnostic. That's, for example, where FlexPay fits. We really wanted to have something that could be connected into by API in the cloud. It's middleware. It has all this world-class AI and machine learning inside of it, and it supports any processor downstream and multiple platforms upstream. And I think that's really the right way to tackle this. Most, again, world-class merchants typically have more than one processor so that they can not have a single point of failure inside of their business. Or they might be running on a custom platform that doesn't have a solution like this ready-made built into it. But even still, a lot of the platforms that are out there, anything to do with payment authorization management is kind of like it's an afterthought. It's not their core competency.
Right.
They'll roll out a solution that's rules-based. It's probably good enough. But as merchants get larger, and percentages don't pay bills, dollars and cents do. So once you have a certain volume of dollars, every additional 1% or 2% of additional recovery you can get becomes really, really important. So that's the time when we need to say, who are the specialized firms out there that have really built something innovative, unique, and highest performing in this particular segment, and how easy can I connect into them? I think the solution that we've taken, which is an API-driven, cloud-based, highly secure technology with all the AI inside of it, is the right way to do it.
Right. Well, the acronym that I just keep remembering is PAM, Payment Authorization Management. I think that's that is this should be the year of PAM in 2022, the year of PAM too, because as I said, there are a lot of situations where losing business is sometimes hard to prevent for lots of different reasons. But when you can mitigate it, when you can prevent it, and there's a solution that allows you to do that, it certainly makes a lot of sense to look further.
I agree. This is the low-hanging fruit that just can give us massive outsized returns and rewards in our business when we get it right. And as the economy kind of shifts and we see less net new people coming into subscriptions, which is also something interesting came out of the case study, that means it's even more important than ever before to retain the people that we do have.
What was the one data point, Daryl, of the study that when you saw it, you said, huh, that surprises me, and that really makes what it is that we are trying to solve for that much more relevant?
I'd say there was really two. The baby boomers thing really kind of surprised me to see that it was essentially 100% churn If we had a failed payment and we engaged by email or text message or mail with a baby boomer and told them about the problem, it universally turned into churn for that. That was surprising to me. The other one that kind of really stood out to me as a bit of a surprise was what percentage of people that were somewhat dissatisfied, but still happy to stay with a brand suddenly became into, I'm done with this, or maybe even becoming detractors of a brand. And the only differentiator was how you dealt with the failed payment. Were you reaching out to them and letting them know the way you communicated, whether or not you suspended the service? I mean, we all knew intuitively that there was probably some gains to be had around optimizing this, but I was shocked to see like the anger almost that came out in this study of people saying, yeah, I'm done with you. I'm ready to move on for something else. So that was an interesting takeaway for me.
So big numbers too. I mean, 38%, 39%, 100% of different types of consumers who just use that as an opportunity to sever the relationship. Well, Daryl, I think this study was very eye-opening for us certainly, and hopefully for the subscription commerce economy, because it seems like a simple thing to address.
Yeah, and again, can't thank you enough for you and your team's support in kind of doing this study and getting the word out there to help people know that there really are better solutions to deal with this, and the wonderful world of opportunity that's available to them if they get it right. So thank you very much for the platform, and I've really enjoyed these conversations.
Yeah, me too. The invisible hand of invisible recovery.
I'm gonna steal that from you.
You can steal that. Be my guest. Always great. Thanks, Daryl. Thanks for your time.
Cheers.